Welcome to this exclusive call for the Manual of Ideas members and clients with the senior management of Lender Processing Services. It's my pleasure to welcome everybody. My name is John Mihaljevic, and from the Manual of Ideas I have Oliver Mihaljevic on the line, who is our Director of Research. And I'm very pleased today to have the management team of Lender Processing Services with us. We have Hugh Harris, President and Chief Executive Officer, Thomas Schilling, Executive Vice President and Chief Financial Officer. We also have from the company Nancy Murphy and Mary Edenfield. And the way today's call will work is Oliver will engage the management in a discussion for about 30 minutes, and then we'll open it up to your questions. You'll be able to ask questions both by phone and as well as you can type in your question if you're joining us online, and we will read those questions. So without further ado, I want to turn it over to Oliver, who can perhaps introduce the management a bit more and then launch right into an analysis of the business. Oliver?
Sure. Well, thank you, John. It's a real pleasure to have LPS management here with us today and discuss the business. Certainly excited that we have somebody of Hugh Harris's stature on this call and his experience of running this business while it was still part of Fidelity National Financial, so prior to the spin-off. So it's great to have that long-term perspective there, as well as the more recent addition of Tom Schilling, who has also been with the company during this challenging time. So we're very excited to have you on the phone today. There's been a lot of noise in the market about the challenges that the company faces regarding litigation and regulatory issues, as well as the revenue pressures in the transaction-based businesses. However, what really stood out to us when we did the analysis was that there is this valuable annuity-type business represented by the mortgage servicing platform, which we think is missed by the market. And so perhaps we can start with that. Can you describe what that business does, and how do you see the long-term economics and competitive advantage of the mortgage servicing platform?
Okay. Well, this is Hugh Harris. Oliver, I appreciate the intro there. Let me give you a couple of seconds just on background around how I got here and what we're doing. As most of you know, at this point, I've been here about 4.5, 5 months, and we came in to really try to stabilize the company and get it back on the track that it was on before. And if we go back to 2002, 2003, when Fidelity was looking at Alltel, Bill Foley asked me to come in and do some consulting work with him when he was trying to buy the mortgage servicing platform from Alltel. And when we worked through the transaction and decided to do the deal, he asked me if I'd come on board and run it for a few years, which I agreed to do. And it was something that I felt really strong about, because it's a great system. It's a system that we had actually operated on as a mortgage company for many years. I've been in the mortgage business about 30 years, knew all the mortgage players in the industry, and had actually operated on the mortgage servicing platform as part of Alltel. So when I came on in 03 and we bought the system, the MSP piece of the business was clearly the hub of the whole deal. That gives you the real tie-in with the mortgage companies on the servicing side. Everything else that we do today and that we did then operates around that hub. The core business itself handles everything from loan setup all the way through the processing, accounting, customer service, etc. And all of the servicing employees sitting inside the servicing shops of the major banks and mortgage companies operate on that every day. They hit the system numerous times a day to access information. It gives them guides on how to do all the functions inside the servicing of a mortgage company. When I was here in 03 to 07, we were really focused on the consolidation of the industry. At that time, all of the big banks were buying up most of the mortgage companies. And so consolidation was happening rapidly. While we were here during that period, we re-signed Wells Fargo. We signed WAMU, who had left the system. We brought them back. We also did an extension with the Bank of America, and finally did a deal with Chase right before I left. After that, obviously, Bank of America bought Countrywide and made the decision to convert off of MSP onto the Countrywide system. And as most of you are aware, I'm sure you've seen the issues that Bank of America has faced over the last 2 or 3 years. So when I left in 07, we had about a 62% market share. And when I came back, now we're sitting on about a 52 or 53% market share. But we are having dialogue with a lot of the companies that are not on MSP today. It is an outstanding system. It's by far the best system in the industry. No one can really touch not only the market share, but the functionality and the capabilities of the system.
Can I just ask you, related to that, so when you say it's the best system, what makes it best? Is it really the scale and the customer relationships that you have that enables you to be the lowest cost provider of this type of product and service?
Well, scale is certainly a huge factor. The biggest piece that I look at with the MSP system that I think gives us the advantage that it does is the fact that we're operating with all of the best-in-class service providers. So we have an opportunity to share best practices with all of our customers. If you look at our competition today, the biggest competitor we have is in-house systems. And if you consider Bank of America and Countrywide as an in-house system, they're not able to share best practices with each other. At MSP, and as they deal with all the customers, we can, we just see what works and what doesn't work throughout the technology space. And our biggest external competitor today is still probably Fiserv, and they have less than, I don't know, 7 or 8% market share, somewhere in that range. So scale has been important, but really being able to take the mortgage banking talent inside of LPS, use that talent to gather data, gather information, share with other customers, and sort of teach everyone how to best use the system, I think is the biggest strength of the system itself.
And you mentioned on the recent developments, you signed up additional customers to the MSP platform. So can you help us understand what drives the outsourcing today, and where do you see that trend going over the next 5 years?
Well, I think outsourcing is going to continue to be a big factor. And if you look at the regulatory environment that we're all dealing with today, banks and mortgage lenders are going to be forced to deal with vendors that are compliant, who have gotten the gold seal of approval from the regulated environment. MSP will be the only provider coming out of this process that's been through the scrutiny that we've been through with the regulators. As most of you know, we've been under the consent order since April of last year. The consent order had 3 phases, and this was all with the banking regulators. And the first 2 phases were completed in September. We're now beginning phase 3, hopefully over the next 2 to 3 weeks, and expect to have that completed in somewhere around mid to third quarter of 2012. So again, as you look at the banks and you look at the big mortgage companies, as we go in and visit with the customers and talk with all of their leadership, they're all focused on how to outsource certain pieces to somebody that has more expertise around those areas than they do. They can't afford to build that expertise internally. If you look at MSP today, we have about 200 people every day that are focused on the regulatory and compliance changes in the industry. Most mortgage companies can't afford that kind of investment. If you look at our spend, we spend about $105 million a year in CapEx, which allows us to keep a system up and running and progressing like smaller players can't spend that kind of money and can't keep ahead of the changing environment. So outsourcing appears to be, from talking to the customers, something they are going to be focused more and more on as we go forward, and we certainly plan to be a big player there.
And it's really extraordinary when you look at the technology segment that you've been able to grow revenue and profits for the 3rd year in a row in this business, and that's in large part due to the strength of this MSP platform, but also speaks to the opportunities that you've been able to take advantage of this regulatory environment to drive some other products through it. Can you tell us more about the growth opportunity, so to use the MSP platform and that relationship to then come up with new products that are addressing new challenges, and give us some examples there?
Well, again, if you think of MSP as the hub and you think of everything else working around that, it gives us the opportunity to take the expertise and the talent we have in the organization and reach out and find out where the customer's needs are throughout the organization. We have relationships with all of the top 20 originators today. We've signed about 7 new MSP customers in 2011. All but 3 of the top 20 servicers are on our system today. The only ones that are not at this point are B of A, Citi, and GMAC. We are having dialogues with those groups even as we speak. And again, there's so many things that we have to offer, both on the transaction businesses, but also on origination technology and default technology, that having relationships, having access to their people, having skill management here. If you look at what we talked about on the earnings call and all of the management changes we've made, in every case we've put in people that had deep mortgage banking experience, mortgage banking relationships, and they're helping us drive not only new business, but making sure we're hitting it in a regulated and controlled environment. And having come out of big banks, most of our management team today knows how to operate in a regulated environment and knows how to operate successfully in that environment. And they are all becoming trusted advisors to the servicers. So it is opening up many opportunities for us, and that's why you've seen the growth that we've been able to experience and should continue to see growth in this area as we go forward.
One area that I'd probably point out too is in the other technology, one of the big catalysts has been the desktop technology, which is the leading technology used by servicers for managing the default process. So when a loan goes into foreclosure, it's the desktop system, which is a workflow and case management system. It's utilized roughly now by about 80% of the loan volume out there. So servicers who represent about 80% of the loans outstanding in the U.S. are using the desktop for their default management system. That's what's, through 3 of the toughest years in this industry's history has allowed us to continue to grow by winning share. I mean, I think we were at, in 2009, desktop probably had around 40% share and has, doubled that to about 80% share just over the last couple of years. And I think it's, to Hugh's point in terms of going to outsourcing, I mean, I think that's indicative of when you look at when desktop really had its growth surge, it was after many of the processing issues came to light in the with the servicers. So some of the regulatory overhangs that they're still dealing with, when those things became apparent and banks, I think, realized that some of their internal processes and their technology to keep up with the volume of foreclosures, in this case, were not where they needed to be, and that's when we started to see the likes of Wells Fargo, JP Morgan Chase, and Bank of America come over to the desktop system, which is what drove the market share there. And at the same time, our origination technology, as Hugh mentioned, through 3 of the toughest origination years, has also continued to hold its own on revenue and actually show modest growth each year.
Looks like we've lost Oliver for a minute. Let me jump in here. This is John, and just ask sort of how you look at the business from sort of the financial side of things in terms of where you see the long-term margins, and perhaps if to the extent that you've talked about this, if you can also give us a little bit of a sense for how that may differ by segment.
Yeah, this is Tom. The margins on the technology, data, and analytics segment have been, pretty robust over the years, and you can see it pretty resilient as we've rolled out new technologies as well. We're at about, in 2011, we had about a 43% segment margin on that business. Our transaction services, the loan transaction services, which encompasses both the loan facilitation or the origination side of the business as well as the default services side of the business and the transactionals, is about 23%. Also been it's an 23% EBITDA margin at the segment level, and that is also been very resilient in spite of the huge reductions we've experienced on the transactional side in the number of volume or the volume because of refi activity has declined over the last couple of years, as well as the default volume due to some of the regulatory delays. So I think it shows from a financial standpoint of the resiliency of the of not only our technology, data, and analytics segment, but also our transaction services, so that we can manage those businesses up and down pretty effectively with the volume. And we would see long-term, obviously it is a business that can scale. On the transactional side of the business, we think as volumes begin to come back, particularly on the default services side of the business, when some of these delays and the regulatory overhangs start to be managed through, that business will gain a little bit of margin on the way up, because obviously it will scale up on that business. So, but we see, but the counter-cyclical nature of those two businesses on the origination side and the default side, we think will keep that in roughly that 20% to the mid-20% range on the high end as we go forward, regardless of the volume levels. And then on the technology, data, and analytics segment, certainly, a little, roughly half of that business is the mortgage processing system, which we talked about earlier, and that is the recurring revenue stream, and it's a recurring, high recurring margins on that business. Our other TD&A segment tends to be a little bit lower margin than the mortgage processing space, but should have opportunity for a lot of growth in the future. And that is also any technology business that when we see the when we see the revenues go up there, we will see expansion of margin on that other TD&A.
And Tom, it's Oliver here again. Sorry, I had a technical issue. I hope you can hear me now.
We can.
Great. Just to focus a bit more in detail on the transaction businesses then, if we can start with the loan facilitation segment, can you help us understand the key revenue drivers there and perhaps break it down by origination? So what is the revenue opportunity per origination? How can we construct a model to think about the revenue in that segment?
Yeah, the transaction services business, or I'm going to break it down and talk about the origination side first, which we refer to as loan facilitation. And within loan facilitation, there's two key revenue components. One is our title and close segment, which handles all the settlement services largely tied to refi activity. So when people are refinancing their mortgage, there's generally they're moving more and more to that activity as a centralized function to have better control over from the servicer standpoint. So for refi originations, there has been a strong movement in the industry to go to centralized providers like LPS. And so we provide those services on title search, title insurance, and the closing and escrow functions that come along with that refinancing activity. In addition to that, we also have a appraisal management company that provides the appraisals in a centralized environment. Appraisal business is also tied largely to the refinancing activity, but it's got a little bit more participation in the purchase origination, because there is a little bit of a movement to move more and more of the appraisal management function to be in a more objective, centralized environment to break that relationship with the local community where most of the purchase transaction is really handled today. So those are the two key drivers. I mean, the drivers of the business are really on loan facilitation, the level of refi activity in the United States for refinancing mortgages. The higher, the title and close is clearly the higher margin side of our business, and we would, for every refinancing opportunity that comes through that we handle, it's roughly a $750 to $850 transaction that we handle for refinancing title and close. That is, and then on the on the appraisal side, it's roughly somewhere between $350 and $450 per appraisal that runs through the organization. On the default side, I'm sorry.
Sorry, that's very helpful. Just thinking about where interest rates have moved here in the last 6 months, how do you view the opportunity to take some more revenue, and what are the stumbling blocks to refinancings in your view?
Yeah, I think if in a stable interest rate environment with what we've seen recently, we still see the market as being a good market where I think we will see some very sustained profitable business for us. Now, what is better for us is when we see interest rates falling, because that means people even that refinanced in the fourth quarter of 2011 might also be eligible to refinance in 2012. But I think a stable market will probably provide what I would call fairly stable volume levels with the end of 2011, if we see that. Most of the predictions that are out there in terms of forecasts for refi predict that there will be a decline of roughly 20 to 25 to 30% volume in 2012, but most of that is predicated on an uptick on interest rates of roughly 15 to 20%, going from roughly 4% up into the high 4s. So I think if we see a relatively stable interest rate environment, we will continue to see the activity there pretty good. Now, one thing that I should mention that could be a real catalyst for significant volume is what you'll see is that there are literally about, depending on where you cut it off, there's about 10 to 15 million mortgages out there who would quickly refinance down at today's lower interest rates if some of the restrictions around loan to value would be lifted in terms of refinancing. That's a lot of the chatter you're hearing out of Washington these days about trying to come up with a solution where they can help facilitate people who are trapped in 6.5% interest rate loans, but their mortgage is higher than the value of their house, is allowing them to waive that loan-to-value criteria and let them take advantage of the lower interest rates to avoid more stress on the housing market as we go forward. So to the extent that something like that can get rolled through, and the HARP 2 package that they've been talking about, I think if those things are successful, we could really see a banner year in 2012 for loan facilitation. But at this point in time, that's a lot of work that has to be cut out. So I think right now we're looking at, one where we may see volumes down slightly, or maybe roughly flat with the end of 2012 or 2011.
Sure. Well, that's a very interesting point, and certainly on the default side as well, there is theoretically a huge revenue opportunity from the foreclosure delays. How do you think about that, and do you still believe that these foreclosure delays will represent ultimately a deferral of revenue and not a permanent loss?
Yeah, it's still our view that the vast majority of the roughly 4 million seriously delinquent loans in the country will eventually have to come through the foreclosure process. There's really just not enough solution out there to solve a big number of those to avoid them coming through. So we would look at those 4 million loans having to come through the system, so to speak, so to process through the foreclosure systems of the various states over the course of the next year, to then probably take anywhere from a 2.5 year to 4.5 year kind of time frame, to where we would have a relatively high level of activity in the industry as we digest that large bubble. But I don't think that it's in working with our clients, and I think just looking at how big the number's gotten, it's pretty clear there's a consensus that it's not going to be managed as a huge surge and then a huge drop-off, that it's probably going to be a sustained high level of activity for a period of 2 to 4 years once the activity starts to come back.
Yeah, I think people have learned that it's going to have to be managed in a controlled way as they open the gates back up.
And in terms of when we look historically, certainly foreclosures have always been there with us, averaging about 0.5% of mortgages outstanding historically before the housing crisis drove this figure to about 4%. Can you help us understand, when we look at your financials and the revenue that the default management business had before the housing crisis, what could we be missing if we just want to use that revenue before the crisis as a normalized figure? So in particular, how has your market share changed over the last 5 to 7 years? Can you help us understand the opportunity there?
Yeah, I think two things that have changed since numbers of around in 2006 or 2005 level. The one, we have taken a large amount of market share. So I think that our market share is roughly probably double the level it was, or thereabouts, from where it was in 2005-06 timeframe. In addition, I think the 0.5% default or delinquency rate that occurred, or foreclosure rate that was has kind of been pegged as the historical norm, was really a norm that was created in anything but a normal time. I mean, if you look at the time period of 1990 to 2005, many foreclosures were avoided largely because of the surge in housing prices. So the number one, one of the biggest reasons for a foreclosure, generally, historically, back in time, is a negative equity situation. And what was happening during the 90s to the 2005 is people, because we still had points in time where we had recessions and we had people with higher, people losing their jobs and periods of high unemployment. Those didn't result in as high a level of foreclosure because most people were able to get out of situations with a house that they couldn't afford and sell it, above the equity amount, above the amount they still owed on the house.
Or you refinance it and get cash out.
Yeah, exactly. Refinancing and getting cash out to help you while you're unemployed. Right. So there's a whole bunch of things that I think were happening during that period of time which will not repeat themselves in the next 10 or 15 years. That we're probably making that figure a lot lower. So I think once the bubble is, the 4 million loans are digested and we go forward, I think we're going to find the normal. And it's hard, we can't tell you what the answer is, but I think the new normal for the foreclosure rate or the default rate is going to be probably north of that 0.5%, but certainly not at the 4% level we've seen for the last year or two.
Yeah, and just to add to that, our default technology was in its infancy. If you look back in 2005, 2006 timeline as well, and as Tom said, now we're at 80% market share with that technology. So we do think we would look at a significant market share increase.
That's very helpful. Well, John, can we open it up to questions from the audience now?
Sure. If you'd like to ask a question, you can click on the interface online to raise a hand and let us know that you'd like to ask a live question. You can also type your question into the interface and we will pose it for you. So I will pause just a minute to compile the Q&A roster. We do already have one question coming in from Jeffrey Ham of Van Bema Value Partners. And the question relates to the balance sheet. What is the right level of leverage that you see for the company? And what are your expectations for deploying the significant free cash flow that you generate?
Yeah, in terms of the correct leverage, I think we've stated we'd be more comfortable down at that approximately 2 times levered, where we were prior, or probably in the early part of 2011. We've actually seen our leverage increase, not because we've taken on more debt, but because of the delays and the cyclicality of the industry. We have gotten our EBITDA has declined a bit. So we'd be more comfortable in that 2 times. And actually, I think the way I would think about our leverage going forward over the longer term is really kind of what the leverage on the technology business is, the TD&A segment. And I think we'd probably be comfortable with, because of the recurring nature of that business, we'd be comfortable with a little bit higher leverage on that, say in the 3 times range of EBITDA, and then probably having very little to no debt levered on the transactional business, which is a business that has to naturally react to sometimes sharp changes in volume because of the cyclical nature of it. In terms of the short term, as we go forward in terms of what we're going to do with our cash flow, kind of with that leverage discussion as the backdrop, our first priority for excess cash flow is going to be to pay down debt in the near term. So I would see us deploying to we have a couple of short-term goals. One, we want to get we wanted to pay our revolver back, and we, as you saw in our fourth quarter We had originally, when we did our refinancing in August, we had drawn down about $115 million of revolver at the close of that transaction. We paid back all but $10 million of that revolver at the end of the year. So we had we have $10 million more to go on that, which we'll be doing in this quarter, and then taking cash, probably above roughly $100 million, and that is the piece that we would kind of call excess cash flow, and we would be looking first and foremost at debt reduction there.
Okay. Just a reminder, I'd ask everyone to also identify themselves before asking a question. We have another question coming in from James Basili with Black Tree Capital Management. The question is, during the margin discussion, you were about to go on to discuss margins in the default segment, but we didn't get into that. Could you please discuss that?
Yeah, margins in the default business are also ones that, they're not dissimilar to what we see in the origination side of the business. That's why those businesses, as they kind of have some counter-cyclical nature to them, we believe in total that LTS division should, generally speaking, stay in that sort of 20% to, when volumes are higher into the, up into the mid-20% EBITDA range. The default side is what we've seen over the last couple of years is the delays that we've seen in the foreclosure process have impacted a lot, have had a much more significant impact on the front end of the business than the back end. And the nature of that business is we provide everything from the front end of the business is what is referred to as default title. So one of the first steps in the process on a foreclosure is basically pulling lien holders, so that when you're about to foreclose on a property, that you identify all the lien holders who will need to be notified that the property is going into foreclosure. There's also posting and publishing, which is more of a front end, which is giving notifications in newspapers, etc. And then the back end of the business is more the asset management and field services. And as you think about these properties that have been started or they've been in default and people may have moved out of them, but they haven't moved to into final as a foreclosure process, and the high level of our REO inventory that still remains out there, the field services business has been much more resilient over the last couple of years, and that tends to be a lower margin business. It's a lot of vendor management, so by its very nature, you tend to have a lot of pass-through type of revenue where you're charging for grass cuts and winterizations and things like that, and it's very much a vendor management model. So that has tended to be a little bit lower margin. So we've had a mixed issue going on with the default services space. But again, when we look at the margins for the loan transaction services division entirely, we think it's a model that under most circumstances should be able to be managed at roughly that 20 to low 20% margin range.
Okay, we're still waiting for additional questions. While we do that, I know that some of our clients and members did have questions about the legal and regulatory topics. You reserved for some of those payments that you expect in the future in the last quarter. Could you just tell us broadly, how do you think about the exposure on those fronts and the estimate that you've made to date? How confident you are in that?
Well, I think clearly we've been working with the regulators very closely, as we've talked about on all of the calls, and from the consent order all the way through the attorney generals, through the other litigation that's out there, all of that was taken into consideration if we put together the charge for the $78 million for the fourth quarter. And as Tom spoke to on the earnings call, we had a pretty high confidence level in the number. The only way we could get everything worked through with the auditors and the accountants. and we still feel good about where we are on that. We've done a lot of work around those numbers to come up to that amount. We've been very clear in our discussions that we will assess that again every quarter as we go forward, and we get more clarity around the settlement discussions with all of the litigation. But at this time, $78 million was our best judgment.
Thank you.
And Hugh, just it's Oliver again here, just to clarify perhaps, can you just help us also understand what this $78 million isn't for? So what could happen that could increase that number?
Yeah, I think what is not included in there is what I would call ordinary, commercial litigation that is kind of, every company has, whether that's employee issues or certain claims that come up from time to time. It's just sort of matter of course in our business. What it does include is all the major sort of regulatory and what we would refer to as the extraordinary items we've been dealing with over the last couple of years, which are the consent order. So it's the remaining cost to resolving all the issues under the consent order, including the potential for civil monetary penalties under that under the consent order, all the various state attorneys general actions, as well as our contemplation of some type of global settlement with the state AGs, not unlike what was announced 2 weeks ago with the banks and the state AGs. It's the U.S. attorney investigation that's been going on for a couple of years. The FDIC suit, which was filed last, I think, April, but was our motion to dismiss most of the gross negligence claims under that. That it is now just a contract litigation that which we will be going through, but is included in that charge, as well as the arbitration case that we have pending with American Home. And so it encompasses all those things that have been sort of extraordinary that we've gotten a good degree of visibility on during the fourth quarter to be able to get ourselves in a position to make our estimates about what it's going to take to resolve those issues.
Great. Oliver, if you have any other questions, please go ahead.
Well, related to that, I guess the corporate costs, I think they were just under 120 million in 2011, excluding the accrual as well as restructuring and impairments that you've taken. That is higher than historical corporate costs. So can you help us understand what has now been included in these corporate costs that wasn't there before, and what to expect going forward?
Yeah, the corporate costs up and through the fourth quarter included many of the costs of dealing with the litigation that we just talked about that are now included in the $78 million charge going forward. And just to clarify, what is included in the $78 million charge, all the items I talked about, but it also includes the ongoing litigation expense for those items. So those items, as we move forward, will not be flowing through that corporate line item. That was the main reason why the corporate expenses were at the level they were in 2011. Moving forward, we expect the corporate expenses to be maintained at roughly that $25 million a quarter, on pace for about $100 million a year. And there may be some opportunities to that as we move forward, but a lot of the increase into the, on the new run rate of $100 million from where it was a couple of years ago is that we do have an ongoing expense related to heightened level of compliance, and that manifests itself in risk management, in compliance management itself, as well as internal audit functions, accounting functions, human resource management functions. Those things have resulted in sort of a heightened level of corporate expenses.
But we do believe that'll come down a little bit in 2013 and beyond.
Yeah.
Mm-hmm. And I guess John, unless there are any further questions, please feel free to stop me. But I was also curious to understand a little bit how you think about the competitive environment, and certainly CoreLogic has been in the press regarding a potential sale, and I was wondering, how do you see, you mentioned some competitors, but how do you see the overall competitive environment, and would you look to acquire a company that could add any capability that perhaps you couldn't do in-house? How do you think about that?
Well, I think as we look at the competition, clearly we've, we keep our eye on CoreLogic and what they're doing. One of the things that Tom talked about in the earnings call is that we are making a significant investment ourselves into our data and analytics business, which will be pretty well completed in 2012, which will give us an opportunity to do a lot more on some fronts around the data and analytics that we've been unable to do in the past. So from that standpoint, we think we'll be much more competitive there. I mentioned the competition around the other spaces, and there really is not a significant amount of competition there. As far as acquisitions, we are, going to maintain a smart growth strategy. We'll be very selective and strategic around acquisitions within the business lines that we feel like we need. We'll use any acquisitions to enhance our capabilities or fill in any gap that we may have. We obviously see every transaction that's being offered up. Some make no sense to us. Some have some appeal. But we're constantly engaged in what's going on around the industry, where the opportunities might be. And I would just see us as we go through these next couple of years, just making sure that we have all of the capabilities we need to satisfy our customers' needs. Because as you have the major players on your system, they're constantly going to be looking for you to help them do more things, and we want to be well positioned to do that.
And perhaps just one last question related to the regulation as a potential source of revenue opportunities. I think that's a point that may be missed in the market as well. People tend to look at any of these regulatory changes as a big negative, but as you mentioned before, regulation and regulatory change has certainly opened up some new opportunities. What is the potential size of that opportunity, just looking at the regulation to date over the last 2 to 3 years relative to your business now?
Well, I don't know that we can really scope the size of it so much, Oliver, but I will tell you that it is opening many, many doors for us. I mentioned that we have 200 people every day focused on the regulatory changes that are going on. These changes are coming quickly in this environment that we're operating in today, and you have to have a team focused on it and making sure that we're able to deal with it. As we talk to these customers, and we've been inside all the big shops a lot over the last 4 months, they are all very dependent on us to help them meet the regulatory requirements that they're facing. So the opportunities are going to be there for us. We're the only company that's been through the process with the regulators, understands what they're expecting, what they need, have made sure that we have made the modifications inside our own systems, and making sure that we can deliver on the requirements for our customers. It is going to be challenging over the next 18 to 24 months, particularly as these companies work through the settlement itself, the $25 billion settlement that you all read about over the last couple of weeks. Once you get into that consent order and you see how aggressive the challenges are for them. Everything has to be done over the next 3 years, and there's a lot of pieces in there. If you don't have the investment dollars to bring your systems up to speed like we have, it's going to be very tough to help these customers deliver on their requirements under that consent order.
Wonderful. Well, on that note, Oliver and Hugh, Tom, Nancy, Mary, I want to end this call. This has been very informative. I also want to just mention for our members that in our online members area, you'll find a video as well as a slide presentation of our thesis on the company, as well as a valuation model, and we encourage you to take a look at that. Also, the company website has a lot of great information on the financial picture and recent events. And with that, I want to thank everybody again. Hugh, Tom, Nancy, Mary, thank you very much.